Hey home builder, John Markey here, your builder CPA, and today we are going to go through a lesson to make sure that you will be successful as a MyBuilder CPA client. So starting out first, we're going to talk about accounting terminology for builders. So you might have heard someone say, accounting is the language of business. And that is absolutely true, but there are all kinds of dialects and nuances that are specific to a lot of different industries, and construction is one of them. Most builders don't struggle because they're bad at business, they struggle because the financial language doesn't match how construction actually works. In this lesson, I'm going to walk you through the key terms you'll see inside your financials so that you can actually understand what your numbers are telling you. We're going to walk through this directly inside QuickBooks Online, starting with the profit and loss, then the balance sheet, then cash flow, accounts payable, and accounts receivable. So let me navigate over here to the reports, profit and loss. So this is the most important report for understanding how your business is performing, especially when it comes to over a period of time. So you can see up here on the left, we have dates, and we can select the beginning date and ending date. Sometimes we want to look at specific months. Sometimes we want to look at a full quarter. Sometimes we want to look at years. Sometimes we want to take a look at multiple years. So if I just go to all dates and then we display columns by year, we can see comparable periods. Now, right off the bat, we have something that kind of irks me about QBO. They call it income here. This is total money that you have received from all different sources, but in the real accounting world, the right word would actually be revenue. But I know QuickBooks has been like this forever and they're never going to change it. So it is what it is. But if I could make one change, I would call it revenue. And whenever you hear me say the word revenue, it's going to mean gross revenue. So all of the gross cash, money, income, receivables, everything that is coming your way to get paid is going to be lumped into what I often refer to as revenue. Now, in the spirit of bending to meet QuickBooks halfway, I might say total gross income. That might be something that I would say emphasis on gross, meaning that we have not accounted for any of the costs that are coming out of that revenue. Next up, we have costs of goods sold. Sometimes we call this job costs. Other times we call it cost of sales. But basically, this is going to be all of the time, materials, and labor that you can allocate down to specific jobs. And what we'll notice in construction reports, even though there's all kinds of different categories that might be related to, such as, foundation, plumbing, electrical, allowances, all of those costs, when we look at your profit and loss, for the sake of simplicity, we're usually looking at all of those items in cost of goods sold. And then later, we will get into more reporting down to a cost code level. But for the sake of simplicity, looking at your consolidated financial reports and the overall health of your company, we can simplify all of those cost of goods sold to be all job-related costs. Now, I know some of our clients have a different setup. Some of them have categories within cost of goods sold. The NAHB kind of advises against that. Another way of saying this would be direct construction costs. That would be the same thing as cost of goods sold. If you have a few key criteria, like say you want to separate subcontracted labor versus materials, that would be okay. At the end of the day, these are your reports for your company, and we want them to be as helpful as possible to you. But really, in the most simple fashion, they are just called cost of goods sold. Now, let's talk about gross profit. So gross profit is your revenue minus your job costs, or your income minus your cost of goods sold. This tells me if your jobs are profitable before your overhead. If you're already losing money up here on this top line, then things are only going to get worse because when we say below the line in the expenses section, that refers to all of your overhead costs. And so it's impossible to regain profitability if you start out with a loss in your gross profit. This is where a lot of builders get confused between markup and margin. So markup is how much you add to your cost to get to your price. Margin is what you keep after the job is done. They're not the same thing, and confusing the two can destroy your profitability. So for example, you might mark up all of your costs a certain percentage, but there could be things that get in the way, maybe warranty claims, maybe rework, things that you cannot bill for, and those actually destroy your margin. So over here, this would be your margin. And this report is showing the total, but another thing I like to do is enable the percent of income, because it makes it more consistent when we evaluate the results. Maybe we will simplify just this month, and we will, so this is a little bit easier to digest. So here, this sample company in QuickBooks, Craig's Design and Landscaping Services, super profitable, very low cost of goods sold. In home building, unfortunately, we probably are not going to see that high of a gross profit. That's just the way the industry goes, but not to say there isn't huge potential. Then let's talk about expenses and overhead. So we have the expense section here. Everything from this line down should be related to overhead, all the way down to where it says total for expenses. So this would be everything that you're using in-house, all kinds of expenses and costs that cannot be allocated to a specific job. So this would be everything related to keeping the lights on in your office, attracting new clients, like I said, things that cannot be allocated down to specific jobs. Then we have, at the bottom, we have other income, and there's actually two elements there, other income and other expenses. As a general rule, I like to keep these as minimal as possible. It really does no one any good if we have a huge percentage of your activity rolling through other income or other expenses. That is not a very descriptive field. So we want to avoid those at all costs. Sometimes other income might include things like little interest deposits that you get in a checking or savings account. Other expenses, I can't even think of what that would be at the moment. Like I said, we try to keep that to a minimum. Now at the bottom, another thing that can be frequently labeled as different words is net income. So some people call it profit, other people call it net income. You can see here, QuickBooks calls it net income, and that's totally fine. If someone is talking about their profit, my mind immediately goes toward the bottom of the P&L. Some people will accidentally refer to profit up here, but as soon as I hear the word profit, my mind is thinking net income, the last number on the P&L, the one that's most important. But if someone says gross profit, then I know that they're talking about the item that is above the line. So this is what's left after everything is paid. All of your people, your salary, but not your draws. So a couple other clarifications. Cash is not the same thing as profit. I think most people know that. Just because you're profitable does not mean that you have cash, and just because you have cash does not mean that you're profitable. This report does not tell you how much money is in your bank. So the P&L, we always look at your activity over a period of time. When we get into the balance sheet, that will be more of a snapshot of your business that tells you your cash on one specific day. Now, let's talk about the difference between costs and expenses. So costs are tied to building homes. You can think of costs as the price of carrying on an activity that will eventually drive profit. Expenses are more toward running your business. So those are like overhead things, things that are a necessary cost of doing business, but they are not necessarily tied to one specific job. And a side note here, while we're on the profit and loss and we're talking about revenue and expenses in QuickBooks, there's some important terminology here where there's multiple types of transactions that can play into revenue and expenses. So when we're talking revenue, when you are going to collect money from your client, chances are you are going to generate an invoice. So when I'm talking about billing your client, I'm always going to use the word invoice, and that's also consistent with a lot of job softwares. When we are collecting money from our clients, we are invoicing them. When we are paying our subcontractors and our vendors, we are getting billed by them. So you see here, when we go to the create menu within QuickBooks, there's these separate columns. So one is customers. You can think of that as the revenue section. These are all of the ways that you can basically deal with your revenue. So an invoice would be something that you send to your client and they're going to pay you later. Later, when they actually send you the money, whether it's a paper check or an ACH into your bank account or a credit card or however you want to accept that payment, we would use this receive payment section. If a customer has multiple invoices and they want to know what their account balance is with you, you could create a statement for them that would show either their transactions over time or the outstanding balance on all of the different invoices that you have sent to them. There's at least 3 different ways that you can create a statement. It's a cool feature that's often overlooked. Estimate. So if you're starting a new job and you do not have a dedicated job software, you can create an estimate in QuickBooks, and then over time you can invoice against that estimate, and that will keep you in line as far as how much you have invoiced your client compared to that estimate. Now, if you're doing cost plus, you're probably not going to do an estimate that you invoiced against. You might do an estimate at the beginning, but as the costs roll in, you'll be entering them as expenses, checks, or bills, and there's a little box that you click to mark it as billable. And then when it comes time to invoice your customers, you can apply your markup. Credit memo, that is you giving some kind of a discount or a concession to your client. I hope we don't see people use those very often. Sales receipt, often confused with invoice. So an invoice, like I said, you're sending a document to your client where you're going to get paid later. Sales receipt is somebody shows up at your office on the spot. They're ready to go. Maybe they're going to give you a deposit. A sales receipt could be one way to record a deposit. Alternatively, if it's an advance deposit for something that you haven't invoiced them against, then you could just receive the payment and then they would have a positive credit balance on their account. Most of you will probably not get into recurring payments, refunds, receipts, maybe a delayed credit or a delayed charge. So that would be something that shows up when you go to create an invoice to your clients later on down the road, and then add customer. That's just an easy way to create a new customer or project within your QuickBooks file. And then we already talked about expense, check, and bill briefly. So an expense, a great example of that would be buying something with your credit card where there was no prior notice. You went to Amazon, you typed in your credit card details. In the most old-fashioned way, we would come into QuickBooks and we would create an expense. A check would be something, maybe a subcontractor drops by your office and they want to get paid on the spot. You could come into QuickBooks and create a check, and you could actually print it from here. But more commonly, what we see is subcontractors and vendors sending bills for work that's already been done, and maybe they expect to get paid this coming Friday or within net 30. That's when you would enter the bill, and under the accrual method of accounting, it is going to record the cost or the expense that you book on that bill. It's going to record it as of the date that you enter on that bill. And then later, when you go to pay the bills, whether it's printing a check or maybe doing an online payment, that's when it's going to be relieved from your accounts payable. So just to clarify that, people who are using the accrual method of accounting, when you enter the bill, that is going to generate the cost or the expense. That's when it's going to show up on your P&L. And then when you pay the bill, so when you enter a bill, it is going to debit the cost or the expense account, and it's going to credit your accounts payable. When you pay the bill, it is going to debit accounts payable and credit your cash account. Now, we don't see people create a lot of purchase orders in QuickBooks, but it is possible. You can do that. A purchase order is a great way to control your costs. It's a document that you and your subcontractor or your vendor both can see that was the agreed upon price at the beginning of their work. And then if the bill comes in later and it's for a different higher amount, you can always look back to the purchase order to see what changed. Why did it come back in higher? It seems like my clients who use purchase orders realize about a 10% cost savings on most of their jobs. Vendor credit, this would be if someone gives you a credit on a bill that they sent you. The most common scenario that we use is a back charge. So when a subcontractor or vendor needs to be back charged for damage that they caused on your job site, if we're not using any kind of a job software, the vendor credit field is the best way to record that. Credit card credit, that might be like a refund on your credit card. You can print checks, you can add a vendor. So those are some important terminology in QuickBooks Online. Let's move on to the balance sheet. So I will come back over here and go to reports, and we'll go to the balance sheet. Now remember, the profit and loss shows your success over a period of time. The balance sheet shows your company's financial snapshot as of a certain point in time. So you can see the difference here. It is technically giving us a range, but at the top of the report, it shows as of this date, March 30th, 2026. The only field on the balance sheet that's going to change if you put in a range is down here where it says net income. So there's a few things that always have to be in line with financial statements. So if we were to duplicate this and go back to the profit and loss, the net income will be on the balance sheet. So let's go to and this is a feature of QuickBooks where it's forced. So here we have net income $1,438.29. If we come down here, we see this exact same number in the net income. So once you know where you're at, once you know how successful this period or this quarter, this month, whatever time frame you're looking at, that number feeds into your equity at the bottom of your balance sheet. But let's go back up to the top. So the assets are all of the things, all of the good things that you own. Usually they're good things. So, you know, bank accounts, those are pretty straightforward. Checking, savings, you might even have like a zero balance account where it always has a zero or a negative balance, and your bank moves money from like a savings account to a checking account every day to manage a zero balance account. Maybe you use Positive Pay and you don't want a lot of people to know you're routing an account number. Those are pretty straightforward. These will always have a bank statement that we can reconcile to. So the bank statement comes from the bank, which is an independent third party. They tell us what your balance is as of the end of the month, and we complete the reconciliation accordingly. Accounts receivable, that's a little more abstract. That's driven by all of the invoices that you generate to your clients. So there will not be a statement here, but we should be able to go to all of those invoices that are on the AR aging summary. We'll get to that later, and we should be able to validate that they're actually there. Now, if you have invoices on your AR aging that you know are never going to get, you're never going to get paid for those, we might as well get them cleaned up now. Inventory, so most builders and remodelers don't use this account very often, but if you are a spec builder, this can be a handy account so that you don't have a disproportionate amount of costs on your P&L. So at the end of every month, we would basically make a journal entry to move all of the costs for that speculation project. We would move it into being an asset under inventory, as opposed to showing huge costs that drive your net income to be negative. Undeposited funds, that's a really abstract concept. I've seen some QuickBooks files where Intuit has renamed this to be like payments not yet deposited. I often use the analogy of, you decide it's time to get paid one day. You've got 5 different jobs that are ongoing. You get in your car and you go to each of those 5 job sites. You collect a check from each of those 5 homeowners, and you can think of undeposited funds as the short period of time where all 5 of those checks are in your pocket as you're on your way to the bank. And then when you get to the bank, the teller puts the checks through their that machine that spins them around and scans them. And then when they get deposited into your bank account, they show up as one lump sum. And so undeposited funds allows us to mark all 5 of those invoices as paid in QuickBooks and then tie it to that one deposit on your bank statement. Then we have a section for fixed assets, truck, all kind, whatever kind of equipment you need in order to do your work. Ideally, anything that's $2,500 or more that is going to provide some kind of future benefit in your operation, we would ideally capitalize it into the fixed asset section. Before we get into liabilities, I do want to point out that there can be some types of assets that are not good. So for example, if you've done work for a homeowner and they haven't paid you and maybe they never will, having accounts receivable is not as good as having money in the bank. And I also want to differentiate between short and long term. So this is one thing that is pretty clear throughout all different types of accounting. Short term is anything that is due within 12 months, so 1 year. Long term is anything that is due after that. And there are some accountants who go through meticulous levels of journal entries and recording things, and at the end of every month they have to reallocate things between short term and long term. QuickBooks, in my opinion, that is way too much work. We would have to charge way too much, and it really doesn't give you any additional insight into your business. So we just use the regular classifications all throughout the year. So anything that's in accounts receivable, accounts payable, or even when we get into some of the other liabilities that we'll talk about later, everything is just grouped into one pot. And even if it's less than a year or more than a year, the only time that really matters is when we go to do the year-end tax return. A lot of times we do split it out between short and long-term there. Technically, it is correct within U.S. generally accepted accounting principles, also known as U.S. GAAP. Add that to your list of terminology. Anytime we're talking about accounting, we need to consider the cost and the benefit. Is the benefit really that great to you to know the difference between things that are due in more or less than 12 months? Are you really going to make that much of a different management decision compared to the huge cost where once we start that cadence of separating out short and long-term assets and liabilities every month, we basically, that's one of those things, once we start with it, we really can never stop. So in my opinion, we try to keep it simple, and throughout the year, everything goes into accounts receivable, accounts payable, liabilities, no matter if it's due within a year or not. Now, we'll talk about liabilities more, but if you do have something like a mortgage, or I know a lot of people got idle loans during COVID, those would go under long-term liabilities down here just because the maturity date might not be for 20, 30 years. So let's move into the liability and equity section. So we'll talk about the accounting equation in a little bit, but the balance sheet always has to balance. So the total assets has to equal liabilities and equity. So you probably, maybe you've heard of someone talk about the accounting equation. In the most basic form, it's assets equals liabilities plus equity. So the sum of total liabilities and your equity has to equal assets. And QuickBooks is set up in a way where it pretty much forces you to be in balance at all times. But the difference between liabilities and equity is important. So liabilities, right off the bat, we have accounts payable. Those are going to be all your trade notes payable to subcontractors and vendors. They're usually due within 30 days, pretty straightforward. There's an AP aging summary report, just like an AR aging summary report, and it lists all of the people that you owe money and how much you owe them, and it even has columns for whether or not you're current with that person. Credit cards, those are used day to day. They don't have a maturity, but they do have an interest rate. Then we have other current liabilities. Payroll, payable, or payroll liabilities are a great example of that. So as you process payroll, maybe there's like a week that goes by before you actually have to remit or pay those funds to whatever taxing agency, whether it be the IRS or your state and local tax agency. But payroll liabilities are always going to be under the current section because no tax agency is going to allow you to hold on to those for more than a year. And then we get into the long-term liabilities. This might be like a long-term business loan, mortgage, something along that line. And then we get a subtotal here for all of your liabilities. So this describes all of the money that you will eventually owe to other people, and all of those people are simply lenders. They don't have any ownership in your company. They don't have any ability to make decisions in your operation. They are just lenders. Now, in the equity section, we ideally have a dedicated account, maybe 2 accounts for each owner. When I say 2 accounts, I mean contributions and distributions. Some people think of that as owner draws, but an owner distribution and an owner draw is the same thing. I think technically, based on the type of legal entity that you are, you might use different terminology, but no matter if you say draw or distribution, I will know what you're talking about when you're talking about the owner draw or distribution. Now, obviously, a homeowner draw is very different. That would be you drawing money from the bank, like a mortgage that's funding their job, or maybe a subcontractor has draws against you. Those are basically just partial payments. But when we're talking about business owners, when they take draws, they would show up here in the equity section. Now, there's not a specific line for it in this QuickBooks file, but we can always add more accounts. And QuickBooks actually teaches us that there should never be anything in opening balance equity. So with all of our clients, ideally we have a 0 here. Sometimes it's not possible. Sometimes this is just an issue of whenever you connect the bank feed, the QuickBooks will go back to a certain amount of time. Usually it's 90 days. They will pull whatever the bank account balance was as of that day, and the other side of that entry will be in opening balance equity. And so usually we resolve that just by coming in here and deleting it and then figuring out how to reconcile your bank account the proper way. Retained earnings, that's going to be everything, all of your net income before the period. And so after this period is complete, QuickBooks will automatically move the net income into retained earnings when we're looking at future periods. So right now we're just looking at the first quarter of 2026. And if we look at the second quarter of 2026, it would already have moved this. Let's actually try that. We're 1 day short, so let's try it. And so it might not be exact. In fact, it's not. But let's see, maybe we have to fast forward to 27 before QuickBooks recalculates it. Yeah, so at this point, when we look at next year, there's nothing in net income because nothing has been booked yet. And if you recall, we had approximately $1,400 in net income, 200 in retained earnings, and now QuickBooks has automatically displayed the net income amount into the retained earnings. So a note on working capital, so that's an important term. It's the difference between your current assets and your current liabilities. This would tell you if you can actually operate your business day to day. So ideally, your current assets, meaning everything that you're going to collect within the next year, would outpace your current liabilities, everything that you're going to have to pay within the next year. Another word that we come across once in a while is retainage. So this is money that's earned but held back until the job is complete. So this would technically be something along the lines of accounts receivable. I know some construction companies will create like a separate account for it, but in the KISS method, I would really prefer just to keep everything in accounts receivable and then go into that report to see the, how overdue things are. Another thing that's commonly confused, so when a homeowner signs up to have you do work for them, a lot of times they pay a deposit, and you might have all builders deal with this a little bit differently. Some of them give it as a credit on the final invoice. Some of them use it as like a pre-construction service agreement and they work off of that. But anytime you have someone pay you up front, it's actually a liability. So the journal entry would be to debit cash and credit liability. And the reason we credit the liability, which means increase the liability, is because you owe something in exchange for that money. Now, as you use up that deposit, we would need to know about it so that we can make a journal entry to release that. So basically, for example, if someone gives you a deposit, it would be a liability until you start spending. Maybe you use it to pay the architect, or maybe you just hold on to it until the end of the job. Both options are fine, but whenever you've satisfied whatever obligation you have for having that money, we can correct it so that it's no longer liability on your balance sheet. And these are just one of the many things where you really have to have an accountant with you who you can trust operating with you on a day-to-day basis, because if someone comes along and wants to set up a liability for deferred revenue, aka deposit, on your balance sheet, and then they disappear, or maybe they don't check on you again until 12 months from now, that's a lot of time that your balance sheet is probably wrong. So let's navigate to one of the most misunderstood and probably missed opportunities, which is the statement of cash flows. So a lot of my clients over the years have opened this report and tried to start tying these numbers to what they might have seen elsewhere, whether it's on the P&L or the balance sheet. But what makes it so difficult and abstract is this is actually reporting to you the change in the balance sheet accounts over time. And it can be really confusing. So for example, if your accounts payable goes up, it will actually show up as cash provided from accounts payable, because that's more cash that you have in the bank because you have accounts payable. There's also multiple different ways of preparing a statement of cash flows. Well, two. There's the direct and the indirect method. QuickBooks takes the indirect method where we start with the net income at the top and basically account for all of the difference in the balance sheet accounts to get to the cash at the end of the period. There's the direct method of the statement of cash flows is more based on the balance sheet alone. The one thing I can tell you is the cash at the end of the period is going to tie to your total bank account balance in QuickBooks. So if we come back over here and we go to balance sheet as of today, and let's see, we've got total bank, hard enough to know the undeposited funds are cash. So if I just take that number and this is kind of ghetto, but we'll do it, plus 2001, Google will tell me 4063.72, wait, 52. 4063.52, and that ties to cash at end of period. So QuickBooks does know that undeposited funds is technically cash, so it will add that plus your bank accounts. But really, I don't find the statement of cash flows to be all that helpful. I know that there's high hopes for it because so many of us are on a roller coaster of a cash flow, and we feel like this would be something that would be helpful to look at, but I think it's more of just an accounting thing. If you are interested in planning more for your cash flow over the coming weeks, months, or years, this is not the report that you would use to start. In fact, we would actually just use an offline spreadsheet for that. That's going to be the best tool as of now. There's all kinds of apps out there that have all of these sky-high promises about how they're going to predict your cash flow better. But to be honest, just a basic spreadsheet is really all that it takes. And actually, many of the Fortune 500 companies, the largest in the world, will have one huge big spreadsheet that is forecasting their cash over the next coming days, months, weeks, all of that. Let's move on to a report that is a little bit more helpful. So if we come back over here to the accounts payable, and I just do a quick search, aging summary. There is the detail report and the summary report. I find the summary report to be most helpful. This is just a list of all of your subcontractors and vendors, basically anyone that you owe money to, people that you haven't paid yet. The bill transaction is going to be what drives this. So anytime someone enters a bill in your QuickBooks, this is where it's going to show up. And that's also why it's important to properly release accounts payable when things get paid. So when we start a new cleanup job, oftentimes we come in here and we'll find some sky-high number in accounts payable, and the business owner will tell me, oh yeah, all of that has been paid. And then we go and we start searching QuickBooks and we see, sure enough, that is true. Most of it has been paid, but a previous bookkeeper who was not very smart recorded all of those maybe from the bank feed, because the bank feed is a trap and QuickBooks tries to just get you to add transactions from the bank feed instead of matching them to existing bills. So that will double record expenses. So that's a problem. And so just a reminder, a bill is something you enter and plan to pay later. An expense is something that you pay immediately. If you enter an expense in QuickBooks, it is going to circumvent this report. It is never going to be here. It's going to assume that that cash is already out the door. So similar to accounts payable, we have another report for accounts receivable, and this would show everything that you've generated an invoice for and have not yet been paid. So the report looks very similar. Just know that there are very important differences between payables and receivables. So then we can talk briefly about underbilling versus overbilling. So underbilling means that you've done the work but you haven't been paid for it yet. Overbilling means that you've billed ahead of the work completed. Both can create misleading financials, and neither of which will really be captured in your accounts receivable or your accounts payable. So if we are going to do a true WIP adjustment, that is likely going to be from a journal entry. So another thing I want to show you is that both on the profit and loss and the balance sheet, you can see up here at the top, there's a toggle between the different accounting methods, cash and accrual. So you'll notice though on the AR aging summary and also the AP aging summary, there is no toggle for cash and accrual. Now, why is that? So anytime we are factoring accounts receivable and accounts payable into the business financials, we automatically know that that is accrual basis accounting. So if we look at our AR aging, we see 5,281, and that number ties to what's on our balance sheet. So all of these financial statements have, so everything in accounting is interrelated. So on every single financial statement, we have at least one number that's going to tie to another report. And that's why when we make one little change in QuickBooks, it usually changes all of your reports. Because like I said, there's always at least one number that ties between the reports. But since the concept of AR is accrual-based accounting, if we switch this to cash, accounts receivable goes away completely on the balance sheet. So QuickBooks does not even factor in receivables when we switch to the cash method of accounting. So it's really nice that QuickBooks allows us to switch between cash and accrual so easily. But in the world of QuickBooks, really the only difference between these two is turning on and off AR and AP. So when you switch to cash, it turns off AR and AP. And when we switch to accrual, it turns on AR and AP. But just because you click the button for accrual does not necessarily mean that your financials are completely in US generally accepted accounting principles. So US GAAP, that is the overall infrastructure in this country for how financial reports are to be generated. And if something is going to be in accordance with US GAAP, at the very least, it's going to be reported under the accrual method of accounting, but there's also going to be other elements that take it one step further. So something that is in accordance with US GAAP is also going to have other accruals that are not naturally created in QuickBooks. So QuickBooks gets you part of the way there if you're going for US GAAP because it includes AR and AP, but it does not include things like payroll accruals. So say for example, this report is as of March 30th. I happen to know this is as of a Monday. Even if we close out the quarter tomorrow, let's say we, take it to March 31st, that's probably in the middle of a pay period. So if you are going to be completely in accordance with US GAAP, then you would have to have a payroll accrual. So you would actually need to post a journal entry for each day that people have worked for you and the wages that you owe them. And that would take it more in accordance with US GAAP. The other thing where we take it from accrual to US GAAP is when we incorporate footnotes. Now, most of our clients really don't benefit from footnotes. That would be a completely different type of service. Now, let me see if I can find an example of something that is fully within GAAP. So this is a company that I used to work at in financial reporting. I was in charge of all of the debt, and let's look at maybe the most recent 10K. Okay, so publicly traded companies are required to have all kinds of additional reporting, and you can see here that in addition to the face of the financials, there's all kinds of notes and text, and it talks you through the basis of accounting that they use, the fact that it's fully compliant with US GAAP. When there are certain metrics that are reported that are outside of US GAAP, it's called out in here. So I just want you to see that having footnotes can be really useful, But when we recenter back to cost and benefit, most of our clients are not really at a level where they would benefit from that. But if that's something that you want to explore, we can certainly have that discussion. So in closing, you don't need to become an accountant, but you do need to understand what your numbers are telling you. Because once you understand the language, everything else in this course starts to make sense. In the next lesson, we'll break down how construction accounting actually works and why it's different from other industries. As always, thanks for watching.